Morning, Top Gun here, Wednesday, May 5th, 3 a.m. on the West Coast. This is the YouTube pre-market commentary. Section 1, QQQ, failed breakout watch. All right, very important. 2 weeks ago, I wrote a post called QQQ, failed breakout watch. The QQQ had broken out from its February 12th all-time closing high of 336.45, but then it was testing that 336 level. Yesterday, it broke through it to close at 330.14, so $6 below that. It doesn't mean it can't reclaim it, but it is noteworthy, especially on the back of big tech's blowout earnings last week, right? The earnings from Apple, Amazon, Google, Facebook, even Microsoft, which didn't get a great reaction, were really stellar, superb even. And so if you look at the chart of the QQQ, we had that breakdown. I've got the all-time high, the February 12th closing high line. You can see we've broken down below it significantly yesterday on decent volume. Now, if we delve in a little closer, we can see a similar type of reaction in Apple and Amazon. So Apple reported this beautiful quarter on Wednesday afternoon with revenue up 54%, net income 104%, and diluted EPS 128% year over year, and yet the stock is significantly lower than it was before reported earnings. What gives? Good earnings, stock goes up. Great earnings, great, same thing, great earnings, but actually the stock went down. Well, this is sort of like what a poker player would call a tell. It almost suggests that all the good news is already priced in to a security when this happens. So no matter how high quality a stock or company is, like Apple, at a certain point it's fully valued, and investors are not willing to pay up anymore for it at that particular time, at least. Things can change day to day. New news can come out. Time can change psychology and get people to feel like it's time again for the stock. But for now, the supply and demand dynamics are not there for higher prices. Same thing applies to Amazon. So if you look at my tweet here, you can see that revenue was up 44% in the quarter they reported Thursday afternoon. Amazon Web Services 32%, and they had $15.79 diluted EPS. The stock exploded higher on Friday morning, and take a look at the chart. It gave it all back, and we're well below where we were on Thursday's close prior to earnings. So again, spectacular earnings, lower prices. Suggests it's all priced in for now. Anything can happen, but technical analysis gives you an idea of what the state of the market is doing right now, where investor psychology is right now. So the QQQ, as I've said many times, is the most important ETF in the market. Tech makes up about, 26.5% of the S&P 500, and it's been the leader off the March 2020 lows, and even through the whole secular bull market from the March 2009 lows. In addition, the semiconductors, the SMH, which I think is the second most important ETF in tech, has broken down below its 50-day moving average on Monday with some follow-through yesterday. So weakness across the tech sector. It's something to be aware of because with tech making up such a big chunk of the S&P 500 and of course the NASDAQ, it's going to be really hard for the market to move higher without them, especially with this reopen trade in the industrials and the financials getting pretty long in the tooth, in my opinion. Lyft reported earnings yesterday, and that stock has really moved, but active ridership was still down 36.4% year over year, though it was up 7.5% from the fourth quarter, and they reported an adjusted loss of $114 million. So, the stock can go up, but it's going up on expectations and hope, not what's going on right now. So I'm very happy in my safe, boring, high-quality consumer staples. Walmart and Procter & Gamble, just going to be old and stodgy, and we might not get rich overnight, but we're not going to lose it all overnight either. See you mañana.